Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at our latest trade idea, a sell strangle on Enphase Energy, ENPH, one of the AI related names on the energy front, since AI will be gobbling up tons of energy along with many other things. But how to take advantage of the extremes, not only on price but also on implied volatility and valuation. So we always like to absolutely use that approach, our fusion approach, if you will. Take a look at the fundamental, technical, and most importantly, implied volatility analysis to help us structure the best trade out there. So let's jump in and take a look, shall we? First of all, here's the scanner, and this is from last Friday's close, right before the Memorial Day weekend. You can see Enphase hit up on the scanner for unusual option activity. Over 60,000 contracts traded, pretty much double the normal volume of 30,000 or so. More importantly, we see IV increasing another 2.5 vol points, and now at the highest level, 100%. So option prices at the highest level of the year on Enphase, all due to the fact of this, we'll see in a second, buying of out of the money calls. Also on my Thinkorswim scanner that I built, you can see Enphase hit up on two fronts here, both in June, the June 65 and 85 calls, both hit up with over 2,000 contracts. This is designed, again, identify unusual option activity, right, that also increases IV. That's where we really find the edge. So that will set up for a very nice trade we'll take a look at in a second. From a fundamental standpoint, simply pulled off two of the most basic valuation metrics out there, PE ratio and price to sales ratio. You can see Enphase on a PE basis now over 60 times PE, right, by far the highest level over the past year. So certainly valuations getting a little extreme, to say the least. Yeah, growth will be there. Will they support this? Difficult to say, certainly. Price to sales following a similar path, right, ripping to over 6 times price to sales, by far the highest level over the past 12 months. Previously, 4 times price to sales was kind of the top here, very similar to previously 40 times PE. So both price to sales and price to earnings getting extremes on the valuation side of things. From a technical perspective, here's the quick chart on Enphase. You can see the stock has ripped higher. Here were earnings, and earnings came out, and they were certainly decent, but not rip-roaring, right? Stock consolidated, then lo and behold, we've seen this absolute rip higher on Enphase, now getting overbought on almost every technical metric out there. You can see 9-day RSI back over 80, which certainly has been a cap in the past. Previous times did signal, as you can see, a short-term top in Enphase stock. So price to, RSI getting to extremes. MACD at by far the highest level over the past 12 months. So certainly MACD getting stretched. Bollinger percent B, which is implied volatility based, also over 100, which is normally a sign that things are getting stretched as well. And that's with IV at the highest levels. We just saw 100% over the past 12 months. Shares trading at a massive premium to the 20-day moving average as well. So certainly the technicals pointing towards the rally, maybe needing a little bit of a period of consolidation, right, to continue here, as the rip-roaring rally probably due to slow sometime out there. Then we always like to look, as we said, at implied volatility, maybe the most important component in my opinion, especially with option trades. Here's a 120-day IV chart. You can see this is from Friday's close, right? Enphase at by far the highest IV level we have seen over the prior 12 months. So valuations at the high extremes, right? Technicals, the most overbought they have been, right? And IV at the highest level sets up ideally for our sell strangle trade we'll take a look at in a second. You can see how much IV has moved higher from Thursday to Friday, from Thursday in red, Friday to green, bumping up across the entire term structure of volatility. Here's a different look, right? And you can see, as we said, here is the earnings pump and dump. Here is earnings when they came out. You see the normal vol crush moving from 90, the vol crush back to around the mid 60 level. Now we're at 102, right, on Friday's close. So certainly IV has exploded, now higher than pre-earnings, right? And earnings were good, not great, but they're looking for obvious meta, whatever you want to call it, growth out there. So IV getting into extreme as well. No, too, it's all on the call side. You can see calls trading at a huge premium on the IV side to put, so that skew, call skew, getting absolutely inverted. Normally, you see the contrary of that. As we said, here is that move. We were going to look out to September. You can see September IV trading close to 100, IV percentile at 100%. Pulled off a chart. Here's a 5-year chart on that 120-day, basically 50 delta call IV. You can see by far the highest IV level over the past 5 years, just ripping higher here, right? All on the fact that they believe that apparently AI is going to continue to fuel just exponential growth ad infinitum. Here's another look on a little shorter term basis over 6 months. You can see what happened in this case to that 50 delta 120-day call, trading at by far the highest level we have ever seen on Enphase. So that sets up ideally for a sell strangle trade. Here is the similar put, and because of put call parity, obviously it puts and calls trading in unison here at very high levels indeed. So that sets up for a sell strangle. So I did a comparative here and went back to February 25th with Enphase just under 50 bucks, right? The September 65.75 sell strangle, selling the 65 put, 75 call, trading at a little bit over 23 bucks, right? The puts deeply in the money, right? So those are, roughly about 15 points or so in the money, carrying a 60 delta, right? And then the calls well out of the money, right, by more than 25 points, carrying about a 29 delta. That trade trading at about a 66, 67 IV, as you can see here. A nice positive theta, obviously, anytime you do the trade. Fast forward to Friday's close, right? The stock closed at 64.03, moving almost to the ideal point, right? The put is almost out of the money, still in the money a little. The call well out of the money. So the stock moved from basically 50 bucks to almost 65. You'd expect that 65.75 sell strangle to drop in price, right? Ideal move on the stock, but because of the massive lift in IV, it actually increased, right, by almost a point, by 90 cents. Why? Because of the IV now at approaching 100, as we saw here. That huge rip higher in IV made that, sell strangle, which should have cheapened certainly by any metric. Plus, you have certainly had plenty of time decay, almost 3 months of time decay, which should have lowered the price of the strangle, right? A beneficial move on the stock should have lowered the price of the strangle, but instead it increased because the move in IV outweighed both the move in time decay and the move in price, the delta and theta effect. So I kind of pulled off a comparative here going back to February 25th. The stock just under 50 bucks at sell strangle, selling the September 65 put and 75 call, was trading right around 23.40, right? The delta, if you would have sold it back then, right, you would have been 31 deltas net long, right? Simply because you're selling a deep in the money put, selling an out of the money call, a negative 60 and a 29. So you'd be definitely net long there. Fast forward to Friday's close. The stock closed at 64.03. That strangle actually increased 90 cents, right? Even with the stock moving up over 14 points to almost an ideal price point for the sell strangle, and 86 days passing, which should have a beneficial time decay or theta effect. But because of the huge jump in IV from under 67 to over 95, over a 40% move in implied volatility, that sell strangle actually increased, right? So that set up ideally for the trade to sell the September 65 put, sell the September 75 call. So over the course of that time frame, you would have expected the delta gain simply because the stock moved towards the ideal, price as far as the trade, right? About $1.40 or so delta gain on the trade. So you'd expect by selling at that price to drop $1.40. Theta, as we said, we had 86 days. You'd expect about $6 worth of time decay, right? So our total that we'd expect that sell strangle to drop would have been over $7, right? Instead, it increased 90 cents. Why? Because of this huge jump in IV. So that's set up ideally again for that sell strangle. Here's the actual trade I did in the account. Here it was from, in this case, Tuesday, right on the opening, selling the SEP 65 put 75 call, right? Getting $24 net credit, selling a 96 and change IV here, right? The delta on the trade IB, 10 deltas net short, certainly not egregiously short. And the fact that the put is still in the money, the call out of the money, but yet your short deltas owes to the fact that the increase in IV skews the deltas a little bit as well. Here is the actual trade in the account mimicking this from time and sales. And then here's the margin requirement. So selling this would have required about $4,000 in margin to sell this strangle one time. From a theoretical perspective, we're really playing more than anything for this massive run in IV just to drop back a little bit, right? We're really just not looking for a massive move in the stock per se, right? But the fact that the IV has gone off the reservation, if you will. So I simply did a quick little Theo calculation, right? Compared it to here is kind of when we put on the trade, that strangle, as we said, trading right around $24. And then just let's assume a 5-point vol drop, right? Not massive, right? We're just looking for IV to go from 97 to 92, basically back to this level here. So not a huge drop here. That sell strangle would increase by $1.40 from a profit perspective, right? Drop $1.40. So that's kind of the edge on the trade. So hopefully identifies how we go about identifying opportunities here based on fundamental, technical, and most importantly, implied volatility analysis, looking for this insane move in implied volatility, right? And this is a 5-year chart to pull back slightly, right? Looking for the fundamentals to at least temper somewhat and looking for those technicals to at least start to soften, and that's all we need to have a profit on the trade. So we'll see what happens with this, but as we always say, trading, right, is never a sure thing. It's about probability, not certainty. So make sure you position size properly and make sure when it's time to get out, you do so. And if you don't know where to get out before you get into the trade, you shouldn't be getting in. So until next time, as always, here's the good trading. Take care.